All right, welcome to this rapid fire explainer. If you're gearing up for your ACCA Business and Technology exam, BT1, you are in the exact right place. I'm going to grab you by the shoulders and walk you through the absolute essentials to pass this thing. We're doing a comprehensive, combined summary of the entire ACCA BT1 subject today. We're zooming in on those high-yield topics, and most importantly, we are going to expose the common exam traps that catch so many students out. So, we're taking this massive syllabus and carving it up into 5 unshakable pillars: governance and agency, risk and controls, business structures, leadership and motivation, and finally, accounting basics. Master these, and you'll easily dodge the examiner's traps. Let's dive right into Pillar 1, governance, ethics, and agency. So what actually is corporate governance? The absolute must-know concept here is that governance is strictly about oversight. Think of the board of directors as the referees. They aren't actually playing the game, right? They're just making sure management plays by the rules. It's all about protecting stakeholders and improving accountability. If you're reading a question and you see words like oversight, transparency, or control, your brain should immediately scream governance. Now listen, do not fall for this classic exam trap. Say you're reading a scenario where a CEO has way too much power, or maybe the board just isn't paying attention to what's happening. Is that a management failure? No way. That is a governance weakness. The failure lies entirely in the lack of oversight. Let's put them side by side to clear it up completely. The board sets the direction and monitors what's happening. That's governance. Management? Well, they're the ones actually getting their hands dirty, executing the work, and running the daily operations. It flows downwards. Owners rely on the board for oversight, and the board relies on management for execution. Keep those two separate in your mind. Which naturally brings us to the agency problem. Honestly, think of this like handing a teenager your credit card to go buy groceries. Their incentives? Probably not going to align perfectly with your budget. It happens when managers act in their own self-interest instead of the shareholders. Because ownership doesn't equal control, a conflict pops up. The agency problem hits when managers do things like avoid a profitable risk just to protect their own jobs. Or maybe they just focus entirely on hitting their personal bonus targets. If those incentives aren't aligned, boom, you've got an agency issue. Moving right along to Pillar 2, risk and internal controls. Okay, you need to lock the ARDA acronym into your brain right now. Avoid, reduce, transfer, accept. This is how businesses respond to risk. If a company completely cancels a risky project, they're avoiding it. If they add controls or start employee training, they're reducing it. Now, what if they buy insurance? They are transferring the risk to someone else. Please don't fall into the trap of thinking that buying insurance avoids a risk. It literally just transfers the financial hit. And finally, accepting is just taking no action, but setting aside a little budget for small, expected losses. Internal controls. Guys, this is a massive, high-probability trap on the exam. It is all about timing. Preventative controls are like the deadbolts on your front door. They stop the burglar before they get in. Think approvals, passwords, segregating duties. Detective controls, those are your security cameras. They catch the burglar after the fact. Things like a bank reconciliation or a performance review. So if a company introduces a dual approval system before a payment ever goes out, that's preventative. All right, moving at lightning speed into Pillar 3, business structures and organization. Let's strip down the definition of a company. The absolutely crucial thing to remember here is that a company is a separate legal entity from its owners. It has limited liability. That means the company itself can own assets, sign contracts, or take out loans in its own name. And because of limited liability, shareholders only stand to lose the money they invested, which completely protects their personal assets like their houses and cars. Okay, look closely at public versus private companies. A huge mistake students make is thinking, oh, it's a massive company with lots of investors, so it must be public. Actually, no, it is 100% about the shares. A public company's shares are traded publicly on a stock exchange, which naturally brings a ton of high regulation. A private company? Their share transfers are restricted and they deal with lower regulation. So public equals listed, private equals restricted. Simple as that. Internally, companies have to pick a structure. You've got the functional structure, which chops things up by activity, your HR, finance, marketing departments. And then you have the divisional structure, which chops things up by output, like specific products or maybe geographic regions. If your exam scenario mentions separate business units for product A and product B, that is definitely a divisional structure, not functional. Here we go, Pillar 4, leadership, management, and motivation. This is an absolute gold mine for easy points. You have to tell leadership and management apart. Leadership? That's all about setting a vision, inspiring people, focusing on the future, and driving change. Management is about execution, controlling the work, focusing on the present day, and maintaining stability. Vision equals leadership, control equals management. Spot those keywords, and you've got the points. Now for motivation. We've got Maslow's hierarchy of needs. When the examiner throws a motivation question at you, just map the scenario straight to these steps. A pay bump? That satisfies a basic need. Job security hits the safety need. Team bonding exercises? That fulfills social needs. And a big promotion? Boom, that hits esteem, making the employee feel valued. Don't waste time writing out the full theory in your head. Just quickly link the scenario to the specific need. You also need to know your leadership style's absolutely cold. If a manager makes all the decisions solo, no input from anyone else, that's an autocratic style. If the team actually votes or discusses things before a final decision, that's democratic. And if the leader just steps back and says, hey, you figure it out, offering no real direction, that's laissez-faire. Auto means the leader decides. Demo means the team decides, and laissez means the team runs free. And finally, we arrive at Pillar 5, Basic Accounting and Finance. Let's strip away all the stuffy jargon here. An asset? It's simply a resource that gives you a future economic benefit. It's going to help you generate income. A liability? A future obligation you've got to pay. Capital is just the owner's funds or investment. Revenue is the income you earn from your normal day-to-day activities. And an expense is whatever cost you incurred to earn that revenue. Keep these one-liners in your back pocket. These terms feed right into the holy grail of financial reporting, the accounting equation: assets equal capital plus liabilities. Think about it. A business has resources, its assets, and those resources have to be funded somehow, right? Either by the owner, which is your capital, or by outsiders, which are your liabilities. Your assets literally must always equal the sum of those funding sources. Let's test this out with a classic trap. If an owner invests cash into the business, what happens to the equation? Just ask yourself how the balance shifts. You have more cash, so your assets go up. And because the owner put it in, capital goes up, right? What if you take out a bank loan? Well, assets go up because you got the cash, but liabilities also go up. Always, always link both sides of the equation. Before we wrap this explainer up, burn these common mistakes into your memory. Misreading the scenario is a killer. Read the whole thing and figure out what's actually happening. Confusing governance and management? Remember, oversight versus execution. Mixing up preventative and detective controls? Just ask yourself, does this control happen before or after the mistake? Fix these little things, and you'll save so many easy marks. And that is the whole shebang. You are now armed with the frameworks, the one-liners, and the trap fixes to absolutely dominate the ACCA BT1 syllabus. You know the difference between oversight and execution, you've got your risk responses locked in, and your accounting equation is perfectly balanced. So the only question left for you is, which exam trap are you going to dominate first?